Well, so I agree 100% that past performance is way overrated. And the type of behavior that we talked about earlier, where people buy what has done well and sell what has done poorly, has systematically led to poor results.
Poor results, yes.
Right? So if anything, just looking at past performance is a perverse signal. I mean, what I like to do when I'm meeting with a manager is sit down, like the people, like the process that they're talking about. Here's something about the security selection process. Have them talk about a couple of examples. And then I like to see the performance. And I actually prefer seeing poor recent performance, maybe good long-term, but poor for the last couple of years, because it could well be that it's a manager with a great process that has had kind of the wind in the face because the markets didn't look favorably on what they were doing. And so it may well be a good starting point. And if they've had great recent performance, then I worry that, maybe they had this wind at their back that will turn and all of a sudden become a headwind instead of a tailwind. But I should get onto the crux of your question, which has to do with survivorship bias and backfill bias. And in almost all areas of active management, when you look at the history of a large group of managers, the results that you see are going to be inflated. And they're going to give people, I think, an excessive level of confidence that it's easy to beat the markets. And why is that? Well, the reason is that the history only includes the winners. Mm-hmm. If a firm fails, they're not in the database, they're gone. And so the history that we look at is written entirely by the winners. And I've done some work where I've examined this over a period of years, and you can see as time passes, the returns for periods ending at some point in the past get better and better as the losers drop out of the database. It's really quite striking, and it's actually worse in the hedge fund industry because there's enormous volatility in terms of large numbers of managers coming in and large numbers of managers failing and leaving, and the amount of the combination of survivorship bias, which is the bias that has to do with the winners remaining, and backfill bias, which is when a new manager shows up with a great record, all of a sudden the new numbers get added to the database even though they weren't there in prior years. It also tends to lift the average. There are estimates that it could be as much as 4 or 5 percentage points a year, overstating the attractiveness. And so that makes the job a little bit more difficult for all of us because we're choosing in the real world, and then we're being compared to this index that is inflated by both survivorship bias and by backfill bias.
How do you recognize a disciplined manager? Because many people, whomever studied your book, would tell us, selling their fund, that they are disciplined.
So
How do you really recognize them?
Part of it's in the discussion, but most specifically in looking at their portfolio choices. So I've had managers in my office say that, oh, we're really focused on small capitalization stocks, and we do very, very intensive research. And then you'll look at a portfolio, could be a current portfolio or one from a few years ago, and then you'll see Ford Motor Company. and you say, well, how is owning Ford Motor Company consistent with your disciplined focus on small cap stocks? And it usually leads to some pretty interesting conversations.
Interesting point. I used to see when I visit some hedge fund managers of fund of funds. Is they say that they have access to the manager at any time.
Yeah.
And one of my questions is, what does give you an edge? Why this is better for your client to have access to the manager? Leave the manager to work.
Yes.
Right.
Exactly.
Give them chances to beat the market and don't disturb during the work.
So we often talk to our managers about assets under management, right? Because I think everybody recognizes that size is the enemy of performance. But another thing that we talk to our managers about is having a limited number of clients. Because the more clients that you have who just happen to be in the neighborhood and want to sit down and chat about the portfolio, the more you're spending time servicing clients and the less you're spending time making investment decisions. And so I think you're very right to point out that produces an issue too. We would prefer that our managers are spending 120% of their work time working on the portfolio, not maintaining client relationships.
Yeah, this happens also with long-only managers. We are a close friend of the directors of the company. I really don't care your relationship with the director of the. As soon as you have a good judgment about the future performance of the company, the risks of the company, competition that is facing, market, etc. That's what is important for us.
Oh yeah, so good friends with the directors can cut both ways, right?
Sure.
You could lose your objectivity. The idea behind absolute return actually came out of an investment committee meeting that we had probably in the early 1990s when Parker Gilbert, who used to run Morgan Stanley, was on our investment committee. And he took a look at our portfolio and he said, David, you have a lot of things classified as domestic equities that are managed by managers that are trying to do things that don't look like the stock market at all. And we went back and thought about it, and he was absolutely right, that there was a group of managers that were trying to generate positive returns regardless of the direction of the markets. And so we said, well, we should classify those differently. They shouldn't be part of the domestic stock market. They should be in a different category. Why don't we call it absolute return? Because they're trying to generate absolute returns, not relative returns, right? And your active managers and your equity allocation are trying to beat the market by 2 or 3 points or 4 points a year. Well, they're trying to generate a return relative to the market. So that's how we came up with the name absolute return. But within absolute return, there are a variety of strategies, including long-short managers and fixed income arbitrage managers and managers that pursue
Credit.
Some credit managers
Okay.
that pursue idiosyncratic strategies. But we recognize that when we aggregate everything, that there's some exposure to the markets, and we try and eliminate that exposure with some dedicated short managers. We actually have 3 dedicated short managers, so when we look at the whole portfolio, we think that there's very little correlation to the markets. And we've got data on this now for more than 20 years of having had the absolute return portfolio in place, and the returns have been actually better than the stock market, with no correlation to the stock market, no correlation to the bond market. And I told you I don't usually look at standard deviation as a measure of risk, but just in this
We
one
don't.
instance,
We don't look at it.
the standard deviation of our absolute return portfolio was a third of the stock market. So lower risk, no correlation, slightly higher return. It's a pretty good asset class.
Yes, I think that we always, regarding, this subject, we always face, the investors always are driven by fear and greed. It's most of, sometimes our clients, they are tempted to bet. And regarding, what role does it play? Really the market timing or the trading and how to trade, right?
Yeah. So I think market timing is a fool's errand. It is something that is so unbelievably difficult that in a vacuum, it doesn't make any sense at all. But the disciplined rebalancing of your portfolio is actually, if you will, kind of a sensible way to time markets, because the rebalancing forces you to buy what has done relatively poorly and sell what has done relatively well, right? And so you're selling what's expensive and buying what's cheap, but it's in the context of maintaining the targets that you established for your portfolio. The type of market timing that you hear about with the commentators on TV and with the people that write newsletters saying the market's overall cheap or the market's overall expensive, that's worthless.
Yeah, they incentivate this emotion from the clients and the investors.
Well, and if you think about it, if these people that are telling you whether the market is cheap or expensive really knew, they could make so much money acting on their information that they wouldn't need to sell a newsletter. That's a hard question. I think when I just look at the managers that I'm close to, a number of managers had liquidity provisions that didn't match the underlying investments that they'd made. That is that they promised that they would return capital pretty much on demand or with 30 or 60 or 90 days notice, when in fact the underlying investments had a longer duration. And so there was this mismatch between what was in the portfolio and what they'd promised their investors for liquidity. And I think that was probably the most fundamental change, because these managers saw a lot of people asking for liquidity that essentially wasn't available, and it caused, I think, managers to rethink the nature of their client base, so that they would have clients that were more aligned, and I think it also caused them to rethink the terms on which they offered liquidity to their clients. But other than that, at least in the group of managers we deal with, no big changes.
May I summarize this with good managers are the same.
Yes.
Bad managers are awesome.
Yes. Yes.
Against
Yes.
survivorship bias.
Yes. Yes.
Let me provoke you a little bit. High frequency trading. You're Michael Lewis or the street? What is your view on this?
So I don't get quoted publicly very often. The only time I talk to the press is when I'm...
Just don't go to the press.
Yeah, no, I know that. But when I write books, and I haven't, written books for a long time, so I don't talk to the press. But I was at an event honoring Jack Bogle, who was the founder of Vanguard, who was a wonderful man. And the topic of high-frequency trading came up, and this was a number of years ago. And I said that it imposes a tax on all of us. And then after Michael Lewis's book came out, somebody at the New York Times found that and called me up and asked if I would comment on it. I said, no, I'm not going to comment on it. But I think that it's absolutely clear that high-frequency trading is an activity that is against the interests of investors. The stock market situation in the U.S. is, I think, a terrible mess. If you could turn the clock back and have the stock exchanges the way that they were 30 or 40 years ago, we would be much, much better off.
Much better than now.
Much better off. There are all these crazy order types. I mean, what orders do you need to manage a portfolio? Buy, sell, buy with a limit, sell with a limit, right? But they've got crazy order types that are out there just so the high-frequency traders can gather information that they can use to exploit the real investors when they're trying to implement their portfolio strategies. So I worry that you can't get the genie back in the bottle, but I'm thinking about like writing an op-ed piece, outlining my ideas about how it is that we should restructure the markets, go back to the more or less to the way they were 30 or 40 years ago, at least in terms of centralization. I think that obviously you'd have more computerization today, but yeah, simple. I think making it simple is the solution to an enormous number of our problems. When you look at the causes of the financial crisis, the complexity of our financial institutions made a huge contribution to that. And the things that really matter, gathering of deposits, making of loans, those are pretty simple activities. But a lot of what got us into trouble came from the complexity that players have added to the markets, and the complexity doesn't benefit the long-term investor. The complexity benefits the financial institutions, and it's bad for society.
For sure.
And this is not only with the equity markets. I probably you have a team that can cope with that, but we as an outsider going to US and visiting the credit managers.
Okay.
So I went there 2 or 3 times. I visit more than 10 managers, and I cannot make an allocation to these managers. I really don't understand what they do and how they do.
Yeah. So I think what you've identified is one of the fundamental building blocks for making decisions. If you can't understand what a manager's doing, you just walk away.
Of course, you cannot measure anything.
Right. And I think that's a very interesting lesson in the context of the Madoff scandal, right? Because
we've been there 2 times.
We went there 2 times.
And if you can't understand it, you walk away.
Yeah.
And you know what? It wasn't understandable because there was nothing there to understand, right? So trust your instincts. And that doesn't mean that we're not going to end up getting defrauded at some point because somebody's clever and they make you think that you understand what they're doing. But if you say, I'm not going to invest unless I can sit down face to face with the principals, and that's another thing, he didn't sit down face to face with almost anybody. Sit down face to face with the principals and understand what they're doing and how they're doing it, then you just walk away.
Yeah,
just stick to the basics. Common sense, a good fundamental approach to asset allocation, and then once you've established that, implement it with a really high quality group of managers where you understand what they're doing and how they're doing it, and where you'd be proud to be associated with them. Just the basics.